Good morning, everyone. Welcome to the Ankerstar Wealth Morning Show. I'll be your host today. Allison is still off for finals week. We're going to talk about three things this morning. We've got the Fed meeting that starts today with the announcement tomorrow. We're going to talk about what a rate hike, 25 basis points, is now the expectation instead of unfortunately pausing. But what a 25 basis point rate hike means to you personally. And then lastly, we're going to talk about some text market scams. If you've ever gotten that random text from a number you don't know that says hi, that is the first step of what a strategy called pig butchering, where they fatten you up before they slaughter you, which is terrible, of course. But it's a $3.5 billion industry is what the article says. So we'll talk a little bit about that. Before we get started, though, this is a financial education presentation. So do your own due diligence before acting upon anything you hear in the show. More information is available at ankerstarwealth.com. Now let's get started with this Federal Reserve. Market is in the red pretty big this morning, over 1% across the board, largely because of the expectation, the unknowns that go into every single Fed rate or Federal Reserve meeting. And particularly this one is you see the Dow's dropping 400 points while everybody gets nervous. So again, these happen every 6 weeks that's when the meeting and the announcement happens, which will be 2 p.m. Eastern tomorrow. And then every 3 weeks is when they release the actual minutes. So really every 3 weeks, the market has something to digest as far as interest rate and what the Federal Reserve is doing to combat inflation. So as a recap, we raised, the short-term rate was raised several times last year, including 475 basis point hikes in a row. That got us up to near the 5% level. This year, there have been a couple rate hikes already, and I personally expect the rate hikes to stop in this quarter, which means either 0% this one, which 97% believe that it's going to be 25 basis points, and they're probably right, or the next meeting, which is going to be at the end of June. Hopefully that will be the end of the rate hikes that are combating inflation. Inflation is coming down, but it's much slower rate than anyone had hoped, for sure. So what does that mean for the market? Market's going to sell off today and then maybe into tomorrow. What you tend to see on the Fed rate days is a lot of volatility ahead of the announcement. And then once the announcement's made, the algorithms run it one direction or the other. And then it kind of settles down throughout the afternoon. Again, there's 2 more market hours after the Fed announces. And then, of course, Chairman Powell will take to the microphone, the last questions, and it will really be the future of the markets really depend on what he's saying, not on what the statement says. The statement, is a one-pager that, again, AI goes in and extracts different changes out of it and makes predictions based off of that. That happens basically instantly. That's why you see that big move in the market. However, what the market will really be looking for is some signal that the Fed is done raising rates. So whether that's through terminology in the actual statement or that's how Chairman Powell answers questions later on. Looking for things like, hopeful that this is enough. We believe inflation has been stabilized, the terminology just like that will give the market confidence that the floor, or the ceiling is in on interest rates and we're at least going to stabilize. That over the long term, the market's actually pricing in some rate cuts towards the end of the year, which, doesn't seem possible right now. But we look historically, and that's completely likely, right? You overshoot to the upside, and then you have to turn around and reverse the work you did. So it's kind of the theory of we're going to raise rates till we kill off inflation or break a couple banks, which they've done. And then we're going to turn around to cut rates to save the economy. That is kind of the path that we are on. Okay, what does it mean to you personally in your household? Well, there's some key numbers in this article that, here's your somewhere in here's the 10th straight time the Fed has raised the benchmark interest rate, fastest pace of tightening since the early 80s, making you feel worse off financially. So there's 2 things happening in your household. Things are more expensive due to inflation. And then things, it's hard to borrow money. So in a perfect world, you make so much to where you don't borrow any money and you live debt free and you're loving life. However, there's ways to use leverage or /debt to affect some things like buying a home. You take a mortgage. So if you have a mortgage out there, or maybe multiple, because you're in the real estate industry, or you have a vacation home or an Airbnb, you can feel the pain, kind of a double whammy, right? Everything's more expensive, and the money that you borrowed to fund these things is now more expensive. Well, what are other ways of borrowing money? So here's your headline: average credit card rates top 20%. You know that my good personal financial planner hat is there's no way to, kill your future. No better way to kill your future than to max out your credit cards and then just pay the minimum, right? Because that's terrible. It is so expensive. It's over 20% that you have to pay. Most of your payment each month goes towards interest and not principal. So literally you can tube your future by doing that. So don't do that. Certainly seek help. It's not exactly what we do here, but there's certain programs out there, like all the Dave Ramsey stuff, that helps you break this vicious cycle. Once you're in it, it can seem impossible. It's not. Keep your faith. But you do need to take action to turn it around. Okay, mortgage rates now average over 6.5%. Again, we were lucky, whatever it is. We most of us benefited significantly from interest rates at 3% or below for a long time. Hopefully you're sitting there with mortgages, if you have mortgages that are at these lower interest rates. CD is paying 5% and you're paying 3% on your mortgage. You, sir or ma'am, high five, have won the arbitrage lottery. This is how banks exist: is they make more money, and then they pay out less. So then you keep the difference. So if you're in a hurry to pay off your house and it's around 3%, financially that is a mistake. However, if it's your goal, just pay off your house and be done with it. But if you really want to break down into how to make money, if you can make more than you're paying out in interest, then you should do that till the end of time, right? And it won't last forever. So pay attention to it now. However, if you're buying a new property, you're going to pay north of 6.5%. If you have bad credit, you may be paying more than that, up north of 7%. Historically, that's not a bad interest rate for a mortgage. Recent history, that's a terrible interest rate. So it kind of depends on how old you are and how far back you remember. My first mortgage in 1999 was at 7%. I was thrilled. I had great credit, young, no debt. So I was thrilled with my 7%. Now that's almost like a heart attack number, just because we've been so spoiled recently. Other numbers out there that may or may not affect you are auto loans. Again, if you can pay cash for a new car, do so, right? Auto loans are, unless you get a 0% teaser loan, which again, they throw these out there. That just means the company's making money the other way, another way, right? So they can make money off your trade-in, they can make money off of being over MSRP, or they can make money through the loans and the kickbacks they get from the financing firms. So again, car companies don't sell cars to lose money, so they're getting it from somewhere. So, but if you can negotiate off the interest off the sticker price, of the car, and negotiate that down to the lowest price. And then when you go in for financing, if you can take a 6.5% finance just to get that lower car cost and then pay it off after 3 months or whatever the minimum is, you're getting a much better deal. So if you're savvy with this stuff, you can do that. Or if you get a 0% and you pay a little bit more for the car, but at 0% for the next 5, 6, 7 years, depending on your type of car, you're winning the interest rate game, if you will. Last one I'll talk about doesn't affect everybody, but student loans, nearly 5%. So those are getting more expensive. That a lot of young folks are saddled with these. They go off to college, they rack up these loans, they go out into the workplace. And if they were to pay off these loans, it would sap most of their salary, right? But they're young, and hopefully if they went to college, they're young professionals now that have professional lifestyles to maintain. So yeah, they show up at 40 years old with a whole 6 figures plus of debt that just keeps growing. Right. So there's obviously some legislation out there that's taken a look at this, and your personal feelings aside, just realize it is a big problem out there. Okay. The last one, pig butchering. What a terrible name. But I know that I get it, which means if I'm getting it, every single one of you is getting it, where you get a random text for some, not only number you don't recognize, it's usually from some area code you don't recognize, because I'm a nerd. I like to guess the area codes when I see them, especially if I don't have it programmed. But somebody says hi. That's how it starts. They're preying upon a lot of behavioral behavioral psychology here, not finance. But yeah, there's a lot of people out there that are going through tough times, are lonely, need a friend, and here comes a friend to you randomly through the internet. These can be tough to combat. So it sometimes seems easy, but I could see how people could fall victim to this. Right, they're at a point in their life, for some reason this makes sense to start up a conversation with a stranger, and they will tell you how amazing you are, that they love you, and basically that's where the pig butchering comes up with, is they fatten you up and then slaughter you, and it'll start, eventually there will be a money ask. That can come in several different ways, but with, we talk about AI a lot, and that's the future, that's the hot tech right now. AI will only make these things worse, and only make this, I think, is actually a human on the other end. But certainly if you can program a robot to spoof people and things like that, it's only going to get worse. So you have to be even more and more diligent to combat these sort of things. So just want to bring it up. If you have stuff like that, whether it's people reaching out through, I may have frozen there for a second, but the bottom line is, if you have people that are not in your circle reaching out to you through the phone, text, or internet, double, triple check that is a legitimate thing. The latest thing, it seems for me, is invoices. I get invoices for things, and I don't know, we have multiple people in the household spending money. So, it's not unreasonable that there would be something purchased that I don't know about, and that's fine. But yeah, take an extra second to kind of double check that those are real. If it's from a Gmail account, it's not an invoice. Period. Dot. That's easy. So start with where it came from, and then do your own due diligence before you move on. So, all right, that's all I have for today's show. Thank you so much for listening in. We'll be back in action tomorrow morning, and we'll be talking more about the Fed. So hopefully hang in there until we talk tomorrow. Bye.